Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The key feature, much as in other grain markets, has been the monthly key reversal up in July. We also had here a similar late March to early July shallow bullish shift pitchfork. And it is the upper tine of this pitchfork, currently at 774, that had been key. This upper tine had capped the market in August and at the start of October, and for a while it looked like it would do so in late October, but it has not. The reason for the breach of the upper tine late last week and a seeming full break higher this week goes back to the drop in early September. This fall was eventually halted by the odd combination of the rising short-medium moving average, currently 734, and the lower tine of the late March to July bullish Andrews not shift pitchfork, currently at 754, and the middle tine of the larger original bullish shift pitchfork, currently 687. If that wasn't enough, just below was at the time the slowly rising medium moving average, currently 697. What that meant was the market was halted and turned back up 5 weeks ago. In the process of moving up, the market created a small reverse head and shoulders formation over the late August to late September period. The market initially broke up through the neckline 4 weeks ago. This move up led me to placing initial target X in the 776 area and a secondary target X1 in the 793 area for this reverse head and shoulders pattern. At the start of October, it looked like even target X would be hard to get. This was because the market had moved up and tested back then the very same shallow upper tine, currently at 774, mentioned right at the beginning. In early October, this upper tine held again, and prices dropped back down to the neckline of the reverse head and shoulders, where they also held. Yet this time, the pressure from above on the lower tine generated a much stronger move back up in a small V-bottom formed over October, such that late last week prices simultaneously broke up over the upper tine and reached target X at 776. Earlier this week, the market consolidated over this broken upper tine, such that yesterday prices rose up and managed to reach target X1 above. The scenario that caused this move higher was the same as in Chicago wheat. The market was getting heavily squished between the shallow upper tine and the market acute lower tine. Even pointing out, as I pointed out last week, and I quote, all the forces reach an apex in mid-November. Well, the market could not wait that long. And we now have broken up out of the top side. Hence, look now at the middle tine, currently at 808 of the July to September bullish shift pitchfork for resistance. But remember one thing, this is a bullish resistance in that it rises 2 cents a day, and it may be no more than corralling action in an otherwise bullish pitchfork base move higher. It is, as I said at the start and at the end of last week's commentary, and I quote, the start of this week's I should say, and I quote, just be aware all this is in the shadow of July's monthly key reversal up. End of quote. Minneapolis wheat. Once more, I feel obliged to say here again, I continue to admire this contract, really admire this contract with some unabated passion, as it has been and still is a series of brilliant pieces of technical action. I've repeated the same mantra now for months, literally months. This despite there being a number of, let's be honest, quite a number of huge differences here in this contract compared to the Chicago and Kansas City contracts. For starters, and supremely important, the December 2020 to early April bullish early April bullish Andrews pitchfork, which has run, I'm going to say it right in the end, which has run this market higher so successfully, was and is still valid here, even though you would have to allow for some of the aberrations we've seen over the summertime. I have covered these aberrations to a greater extent in earlier videos, so I won't tread on old ground. Suffice it to say, the market cooled lower in August and started to accelerate the drop in September, below the middle tine of the original bullish Andrews pitchfork, currently at 941, and the rising short medium moving average, currently 923. However, both these two supports eroded the bearish incentive and re-established the original bullish incentive, such that today, yet another Friday, and yet again we have the highest high in recent times. What is more, the bullish incentive has taken an even stronger turn and pierced and closed over the upper time for the first time since mid-August. We're yet to see if this concentrated move higher and is not just an aberration as we saw back in July and August. But first ideas seem to be that is a strong move higher. The issue is that just above the market we have some significant resistances. The July 2012 high at 1034, the May 2011 high at 1055, to name just two. Meanwhile, below we have now the significant resistance that has turned into support of the 50% absolute Fibonacci line at 974. I have to say, all things do come to an end. Perhaps, just perhaps, these recent actions were the first inklings that the original December 2020 to early April 2021 bullish Andrews pitchfork is heading that way. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.